Okay, this is a very quick Wall Street window update for the week of February the 20th. And I want to highlight in this video 5 stocks that I think are in a bad situation. And you can use them as examples that you should look at in your own portfolio, what you need to be looking out for right now. Because frankly, at this moment, there are actually lots of stocks that are lining up, and you may not even, lining up in a bad way, you may not even want them in your portfolio anymore. And the reason why is what the stock market has done. Now, I'm not saying the stock market's on the verge of a crash or an immediate pullback. In fact, I don't really expect much to happen at all this week or the next week, probably the week after that. We're probably going to actually pause for quite some time here. But what has happened is last year, of course, the stock market basically went straight up without any single pullback at all. In fact, there wasn't even a 5% pullback during the entire year off of a 52-week high on the S&P and the Dow. There was a slight dip in August, but you can't even see it on this chart. It affected the Dow more than the S&P. But what has happened is earlier this month in February, the stock market pulled back about 10%. The Dow fell 1,000 points in a single day twice. But since then, we have rebounded sharply last week. And we're likely to actually pause here. And I don't really think much is going to happen. But a lot of individual stocks have been set up in a bad way now as a result of this recent action. And let me show you 5 examples of what I'm speaking of right here. So this is all these stocks are a part of the NASDAQ 100. This is Shire Limited, and it got smashed very bad on this drop, and it's barely even rebounding. And these are the kind of stocks that when they act like this, when they drop more than the stock market does and the stock market drops, and then when they barely even go up and the stock market goes up, those are stocks that are setting themselves up to later fall even more on just a slight pullback in the stock market. And if we could retest the lows recently made or even break them later in the year, stocks like this will get smashed. And these are just laggard stocks. Now, and I see no reason if you own it to hold it. And in fact, these are stocks that we can even bet against as hedges for other positions that we have. But I would examine the individual positions in your portfolio, and if they display the characteristics of this stock or some of the others I'm going to show you, you may want to consider pairing that position, moving that money into something else, taking action, because you don't want to be doing that when the market's dropping. And it's basically you're getting creamed in some bad positions. You want to pair out now and use, the information. What they're doing is to act on that. Now, on the bottom of this chart, I have 2 indicators. One is on balance volume, and it's a running total of the up volume. The volume on up days subtracted by the volume on down days. When it goes down, it means there's more selling than buying in terms of trading volume. It's a sign of distribution. It's a negative. The indicator on the very bottom is the price of this stock divided by the S&P 500 price. It's a relative strength indicator. When it trends down, it means the stock is lagging the S&P 500. If this indicator were to be going up, it would be meaning it's outperforming the S&P 500. Both these indicators are trending down, which I consider to be negative signs. Of course, the stock is also below all its major moving averages, as another sign that it's a downtrend. This is a laggard stock, and it's likely to continue down throughout this year, even if the stock market just does nothing. And if the stock market declines, this is a stock that could easily get smashed 30% if the stock market were just to fall 15%. So I don't like it at all. And this is another stock, NetEase, the NASDAQ 100, that's starting to display some danger signs. It, of course, hasn't been acting as badly as the previous stock, but it's got warning signs that suggest that it could easily start to do that before this year's over. Again, on balance volume has been trending down since July, and relative strength, it did pop up in November, but it's trending down now. And as you can see, it's below the blue line, which is the 50-day moving average, while the S&P 500 is above it, and so is the NASDAQ. In other words, this stock has barely bounced on the market bounce or rally, whatever you want to call it, over the past week. It's becoming a laggard. If that continues in the next couple weeks, this is a stock that will probably end up tipping over and going below the recent lows, no matter what the stock market averages do. Biogen is another stock that is suddenly getting hammered, suddenly becoming a very nasty market laggard. So as you can see on bounce volume is now only starting to trend down, but the relative strength has collapsed since the stock market made its last peak, and we had the 10% drop. You can see that this stock dropped much more than 10%, almost at twice the rate that the stock market average has dropped, and it hasn't even bounced at all. In fact, many biotech stocks are displaying the same sort of action characteristics or lack thereof, and that's a warning sign that this entire sector is probably going to turn into a laggard and not do very well for the rest of this year. When you have corrections in the stock market, or just like we just saw, you tend to see money leave some sectors, go into new sectors, leadership rotates, and new laggards appear. This Biogen is likely to be a bad stock. Another stock loosely connected, in fact, to Biogen is Hologic. And Hologic had a very sharp drop on this market pullback and has barely bounced. It's in fact not only below the 50-day moving average, but is also below the green line, the 200-day moving average, the red line, the 150-day moving average. It's in a very pitiful situation. Relative strength is in collapse. In fact, it's almost ready to make a new low, go below the lows of October. One interesting thing that must be commented on this stock is in August, when the stock market had just a small pullback, this stock had a huge pullback, and once again, history seems to be repeating as there was a pullback in the market averages in February, and this stock just dumped. So this is a stock that I really don't think is a good one to hold, and I would look through your portfolio and see, do you have other stocks that dumped terrible in August and then dumped terrible again just recently and are barely bouncing? Those are stocks I don't think you should continue to hold. Those are stocks that money should be moved out of into something else. And in fact, if you're looking for stocks to bet against as hedges against potential pullback in the market or other longs you got, then watch and see how these stocks trade over the next couple of weeks, and they continue to act weak, then look to bet against them. Another final stock I want to talk to you about is T-Mobile, and T-Mobile is the kind of stock that a lot of people could easily be holding and not be aware of what's going on. Because it hasn't crashed. It hasn't fallen as badly as those other stocks I've shown you, but it's in a situation where it's likely to do so before this year's over. Notice, T-Mobile is below all those moving averages, but it hasn't fallen that bad. But it's still below all those moving averages. And the relative strength has been in a sharp downtrend for almost a year. And that's bad. On balance volume is sideways at best. We can't say it's making new highs, but it's at sideways at best. This is a stock that's showing technical weakness, but it has not crashed. It has not collapsed. So I'm sure that there's many people out there holding this stock that aren't that worried about it because it hasn't fallen bad yet. But it's displaying technical weakness that they're probably not aware that's happening at all, because most people only react to price action. They don't look at what the indicators are warning about. They're oblivious to what's going on. And that's why now is the time really to sit back, examine your holdings in your portfolio. How are your stocks doing? Are the indicators strong? Are the indicators weakening? What is really going on? And because when I see the market pull back, the Dow fall 1,000 points in a day, 2 days in a row, basically, it's not me. It doesn't mean that we have to say, oh, the stock market's going to crash and I need to sell everything I own. I need to panic and this and that. But it definitely is a sign that, okay, I probably should examine my holdings, because if there's a retest of lows or a later pullback in the year, if I got bad holdings, I'm going to get smashed. And if I want to look for hedges, then now's the time to do it. And so these are the type of things I'll be looking at going forward, and examining my own portfolio is something I just did this weekend, and you should probably do the same. And I'll be talking with you later with more market updates.